Understanding candlestick patterns is an integral part of stock trading and a cornerstone in technical analysis. Each day, a stock trades and forms what is called a candlestick. Basically, it is a shape that can help investors understand price movements. So this video is going to focus on some of the more important candlesticks that a beginning stock trader should know. So first off, let's go over what a candlestick is. So the candlestick is made up of a body or a real body, and this is a rectangular section of a candlestick that shows the range between the opening and closing prices. Long bodies indicate strong buying or selling pressure, while short bodies suggest indecision. Shadows or wicks extend above or below the body, marking the highest and lowest prices reached during the period. This offers insights into market volatility. Now, the color of the candlestick provides a quick snapshot of the price direction for that day. A bullish candlestick is typically green or white. This means that the closing price is higher than the opening price. The opposite is a bearish candlestick. This is typically red or black, and this shows that the closing price is lower than the opening price. The first candlestick we're going to go over is the hammer. The hammer candlestick is a bullish reversal sign. This candlestick has a longer lower shadow or wick, at least 2 times the length of the body. Essentially, the stock will rise back up above or near the opening price. This means that the buyer demand took over. The inverted hammer is another bullish reversal sign, but the opposite of the hammer. Long upper shadow, stock will close lower near the opening price, but above it, making the stock green for the day. The hanging man also looks similar to the hammer. This is a bearish reversal. After an uptrend, the stock price rises for a certain amount of time. With the hanging man, the opening price drops significantly, and the price closes near or below the opening, but red. This is generally a sign that the stock could go down. The spinning top indicates market indecision. Now, the spinning top candlestick can go either way. Neither buyers or sellers have the clear advantage. Price opens one way. The opposite occurs at closure. A bull spinning top would have a higher close, whereas a bearish spinning top would have a close lower than the open. Next up is the Doji candlestick pattern. With the Doji, the open and close price are equal or very close to equal with limited price direction. This can be seen as price indecision. The Doji symbol looks very similar to a cross with a very thin body. Another Doji is the Dragonfly Doji. Open and close very close to equal with a long lower shadow, in fact lower than the previous trading days, but it closes near or equal to the open. This is a similar look to the hammer, however, the body is extremely thin. The gravestone is a bearish reversal sign. This is a long upper shadow, so the stock might originally go up, but then it closes very close to the opening. Basically, it's a sign that the bulls could not keep the buyer demand going and the stock falls down near the opening. That's generally a bearish sign. Maribozu is another pattern. This is a strong candle price. So the stock is going to go to a certain direction and it's not necessarily going to waver too much. The stock is also going to close well above for a bullish candle, or it will close well below for a bearish candle. Next up is the long lower shadow candle. This candlestick is a bullish reversal sign. Basically, the stock is pushed down, but it gets pushed back up near closing. This is a sign that buyers felt the stock price was oversold. On the flip side, you have the long upper shadow candlestick. This is a bearish sign. Now, the buyer and the bids are strong at first in the long upper shadow, but then the price drops and the price closes lower. This shows buyer demand lowered significantly. The next 2 patterns deal with multiple candlesticks. The first is going to be the bullish engulfing candlestick pattern. This is a 2 candlestick pattern. That means it's going to be over 2 days. So the first day is going to be a red candle pattern. If it's going to be a bullish engulfing, the next day is going to have the price open at or below the previous red candle, and it's going to be a strong green uptrend candle that engulfs the previous red candle, almost 2 times the length higher of the previous red day. The bullish engulfing is definitely seen as a bullish 2-day pattern. Next up is another popular one, the Morning Star Candlestick pattern. This is a 3-day candlestick pattern. Another bullish reversal that follows a downtrend. The first day is going to be a tall red candle or black candle, so it's a negative day for that stock. The second day it could be green or red, but it has a short body, so the stock has not moved one way or another too much. The third day is going to be a tall green candle, signifying that the stock is going to burst back. So essentially it goes down, has an indecisive day, and then a strong bullish day. That is the morning star, and that's generally a bullish reversal pattern. So those are some of the main candlestick patterns. Again, it is very important as a trader to understand and be able to read candlesticks and charts. These are just some of the candlesticks that can be used to help identify the direction of a stock. Now, these are not 100% guarantees on where the stock is going, but a lot of times they can give you a good direction as to the price of a stock in terms of uptrends or downtrends. Thank you guys for watching. Don't forget to subscribe, and we'll see you guys next time.